If you are 18 months away from the end of a long debt cycle, the last thing in the world I want you holding is a portfolio built for the world that already ended. That is the first thing I would tell you. If you were sitting across from me today, I would not start with excitement. I would not start with promises. I would not start with a list of hot ideas or a sermon about staying optimistic. I would start with arithmetic, because arithmetic does not care how confident we feel. And arithmetic has a way of humiliating people who mistake a rising market for a safe one. I have lived through enough cycles to know that the most dangerous part of a major repricing is not the crash itself. It is the period right before it, when almost everything still looks normal on the surface, and people take that surface for reality. They see their statements, they see familiar tickers, they hear experienced voices say the same old things about diversification and patience and staying the course. They feel reassured by the fact that they are doing what respectable people do. That is exactly how they get hurt. A man once sat across from me in the he had saved for decades. He had a proper advisor, he had a clean allocation, 60% in stocks, 40% in bonds, the sort of allocation that sounds sensible because it has been repeated so many times that it begins to feel like a law of nature. He was not reckless, he was not chasing stories, he was not trying to outsmart the world, he was following the rules. That is what made him vulnerable. When I told him the cycle looked late, that housing had become a machine for leverage rather than shelter, that lenders were holding promises they barely understood, and that conventional diversification was built for ordinary recessions rather than the end of a debt binge, he listened politely. Then he went back to the people he trusted. They showed him charts. They showed him history in the most flattering possible light. They told him markets always recover. They told him staying invested was wisdom and caution was an emotional error. For a while they looked brilliant. Then the floor gave way. His portfolio did not merely dip. It broke in the way portfolios break when time matters more than theory. He did not have 30 years to wait for elegant historical averages to rescue him. He had a life schedule, a retirement date, a wife, plans, obligations, and a body that had already spent most of its best years working. By the time the market eventually repaired itself, his own clock had not. That is the part many people still refuse to understand. The market can recover and you can still lose the life you meant to fund. So when I tell you we are late in a long debt cycle, I am not trying to sound dramatic. I am trying to keep you from making the oldest mistake in finance, which is confusing a paper recovery with a human one. The machine we are living inside has three engines. The first is productivity. Are people and businesses producing more real value? Are we getting more efficient? Are we creating more output per unit of effort? That engine matters, but it moves slowly. The second is the ordinary credit cycle. Credit expands. People borrow, businesses spend. Asset prices rise. Then central banks tighten, spending cools, and the economy contracts. That cycle repeats every handful of years, and most of Wall Street is trained to think almost entirely inside that box. The third engine is the one that matters most. Right now, it is the long debt cycle, the one that unfolds over generations, not quarters, debt piles on top of debt. Governments borrow, corporations borrow, households borrow. Markets get used to lower rates, then to easy refinancing, then to the comforting fiction that leverage is safe because it has been safe recently. After long enough, the system becomes too indebted to tolerate honest money. At that point, you no longer have a normal economy. You have a structure that can function only if debt is refinanced, rolled, softened, diluted, or quietly inflated away. That is where my mind goes. When I look at the present, when interest expense becomes one of the most important claims on national income, when new borrowing is used to manage old promises, when financial assets are valued as if liquidity will always arrive on command, I stop asking what should happen in a textbook and start asking what always happens in history. History is blunt on this point. At the end of a long debt cycle, paper claims are not all equal. Some are merely numbers living on top of a monetary arrangement that is being quietly weakened. Some are claims on real things, real output, real scarcity, real necessity. During the pleasant middle of a cycle, people forget the difference. During the end of a cycle, that difference is everything. That is why I keep coming back to only 4 categories of assets I truly trust when the structure itself is under strain. The first is physical precious metal. I do not mean an abstract claim. I do not mean a clever product designed by someone whose compensation depends on keeping your money inside a financial wrapper. I mean metal you own outright. The reason is simple. When governments become too indebted, they almost never choose discipline first. They choose relief first. Relief is sold under many respectable names: accommodation support, liquidity, flexibility, stability. But underneath the polished language, the mechanism is almost always the same. More currency units are created relative to the real goods and services those units can command. The burden of debt is reduced in real terms by weakening the measuring stick itself. If the measuring stick is what is changing, I want part of my wealth sitting in something that is not a promise made by the measuring stick. Gold has survived every fashionable theory because it does not require a theory to remain itself. Silver has a similar monetary character with an added industrial one that can make its moves more violent in both directions. Neither produces cash flow, neither flatters the ego, neither gives you a spreadsheet full of projected growth. What they do is much more important in the environment I am describing. They stand outside the credit machinery. That matters. In ordinary times, people resent assets that do not yield. In extraordinary times, they rediscover the difference between an asset that does not yield and an asset that cannot be printed. I would not put everything there. I do not worship metal. I simply respect what history says about it. If I am in the later innings of a debt cycle, I want a meaningful portion of liquid wealth in physical precious metals, because there are moments when the most valuable characteristic an asset can possess is that it does not depend on anyone else keeping their word. The second category is businesses with real pricing power. This is where people who love broad slogans often get lost. They hear that equities are risky or that paper claims are vulnerable, and they conclude that all businesses must be suspect. That is lazy thinking. A weak business at a foolish price is dangerous. A necessary business with durable pricing power, conservative financing, and products people keep buying in hard times is something altogether different. If I own a business that can raise prices without losing its customers, I own a partial defense against inflation. If I own a business selling necessities rather than luxuries, I own a stream of demand less dependent on cheerful economic moods. If I own a business with a long history of paying and raising dividends through multiple cycles, I know I am dealing with a management culture that understands stewardship rather than fantasy. That is why, in this part of the cycle, I prefer plain competence to glamour. I would much rather own a company selling household necessities, medicine, basic services, or regulated utility output than a company selling dreams financed by cheap money. When capital is easy, the market rewards stories. When capital tightens and the value of money changes, the market eventually returns to the old disciplines. Cash generation matters, debt structure matters, customer captivity matters, the ability to pass through costs matters. This sounds boring to people who have been trained to admire drama. Boring is a great compliment in a difficult cycle. The third category is short-term treasuries and cash equivalents. I can already hear the objection. Cash gets eaten by inflation. Treasury bills are dull. Why would any intelligent person hold so much dry powder when there are always things going up somewhere? My answer is that people who ask that question usually think of cash as an asset with a low return, and I think of cash as stored optionality. When markets are expensive, cash can feel like dead weight. When markets break, cash becomes mobility. It becomes bargaining power. It becomes the ability to act without selling something else at the wrong price. It becomes the emotional advantage of not being forced. That last word matters more than most people appreciate. The truly catastrophic financial decisions are usually not made by foolish people. They are made by cornered people. People who need liquidity now. People who believe diversification would protect them until they discovered that correlated selling can make many assets fall together at exactly the moment they need one of them to stay still. People who are told to be patient by advisors whose own lives are not dependent on the same timetable. When I hold a meaningful reserve in short-duration government paper and cash equivalents, I am not trying to beat the market next quarter. I am buying the right to act when the market becomes irrational later. In every major dislocation, extraordinary businesses and extraordinary assets are sold at ridiculous prices, not because their long-term value has vanished, but because someone somewhere must raise cash immediately. The person holding liquidity in that moment is not a victim of the cycle. He is a collector of bargains created by it. That is why I refuse to apologize for dry powder late in a cycle. The fourth category is productive real assets. I want assets tied to human necessity, not human excitement. Land that produces food, real estate with resilient utility and genuine cash generation, infrastructure with real use. Assets whose value comes from the role they play in daily life rather than the narrative attached to them on television. A productive real asset is not just a thing, it is an ongoing claim on necessity. If a piece of land produces calories, that matters in any currency regime. If a property produces rent from genuine need rather than speculative enthusiasm, that matters in any market climate. If an asset sits on top of constrained supply and persistent demand, it has a sturdier foundation than an asset priced mainly on liquidity and hope. The reason I like productive real assets at this stage is not because they are invincible. Nothing is. It is because their value rests on realities that survive the repricing of money itself. That is the thread running through all four categories. Physical precious metals stand outside the paper system. Pricing power businesses keep converting necessity into cash flow. Short-term treasuries and cash preserve optionality. Productive real assets keep generating value because people still need what they provide. Now notice what is missing. What is missing is exactly what most conventional portfolios lean on most heavily at the wrong time. Long-duration bonds are dangerous when inflation or rates can reprick them brutally. Broad passive exposure can hide concentration risk in expensive sectors and fashionable businesses that were built for a liquidity regime that is fading. Speculative growth depends on a future that must arrive on schedule and be discounted at forgiving rates. Late in a debt cycle, that is too many assumptions for me. The central deception of the late cycle is that people still use the language of balance while holding a structure that is much less balanced than it looks. A person can own hundreds of stocks through an index and still be concentrated in a handful of expensive ideas. A person can own bonds and still be exposed to a massive interest rate risk he does not understand. A person can keep money in what he calls safe cash and still be entirely dependent on intermediaries, payment rails, and institutions he has never stress tested. Surface diversification is not the same thing as structural resilience. That is why I would ask you to do something simple and uncomfortable. Open every account, every one. Look at every position and ask only one question. If the next phase of this debt cycle is inflationary, liquidity-starved and hostile to long-duration promises, does this position preserve my real purchasing power, not my nominal balance, my real purchasing power? That question will strip a lot of nonsense out of a portfolio very quickly. You will discover that some holdings depend on rates falling fast. Some depend on valuations staying generous. Some depend on credit staying loose. Some depend on demand that only exists when people feel prosperous. Some depend on you never needing the money during the drawdown. Once you see those dependencies, you cannot pretend not to see them. That is the point where disciplined repositioning begins. I do not believe in theatrical all-or-nothing moves. I believe in replacing fragility with resilience, step by step. In the first month, I would measure reality. No stories, no slogans, just a cold inventory of what I own and why I own it. In the second month, I would begin building the four categories deliberately, not impulsively. I would establish the metal allocation. I would move a meaningful portion into short-duration government paper. I would start or add to businesses with obvious pricing power. I would map the route into productive real assets with patience and actual underwriting discipline. In the months that follow, I would trim what is most vulnerable, not because I know the exact date of the break, but because I know the price of waiting for certainty. Certainty is usually purchased with a lower future net worth. That is the piece many people never learn. At the turning points that matter most, you never get full clarity first and a good price second. You get the opportunity while the story is still contested, while the crowd is still comfortable, while the danger still sounds debatable by the time everyone agrees. The repricing has usually already happened. If you want a working framework, here is mine. First rule, own some wealth that does not depend on someone else's promise. Second rule, own businesses that can raise prices without apology. Third rule, own enough liquidity that a crisis makes you dangerous, not desperate. Fourth rule, own productive real assets that remain useful when financial fashion changes. Fifth rule, never confuse familiarity with safety. Sixth rule, never let conventional wisdom make a timing decision for a life that has a human clock on it. If you are 30, you can survive mistakes that look fatal in the moment. If you are 55, 60, or older, the arithmetic changes. A 50% drawdown late in life is not just a chart event. It is a life event. It takes time, withdrawals, taxes, inflation, and your own remaining working years, and turns them against you all at once. That is why I care less about winning the final sprint of a bull market and more about entering the next decade with intact capital, intact optionality, and intact peace of mind. People sometimes hear a message like this and assume it is pessimistic. I think the opposite. I think it is optimistic to prepare. It is optimistic to believe your wealth deserves a structure strong enough to carry it through a hard transition. It is optimistic to believe you can act before the crowd. It is optimistic to choose discipline over drift. The real pessimism is passive. It says, I hope the same formulas keep working. I hope the institutions can still pull the same lever. I hope my portfolio is stronger than it looks. I hope I will have time. I hope the cycle will spare me because I was respectable. Hope is not a strategy at the end of a debt cycle. I have studied these periods long enough to know the transfer is real. Wealth moves from those who own the wrong things at the wrong prices and in the wrong legal structures to those who spent the quiet window before the storm getting their house in order. That is what this moment is. A quiet window, maybe not silent, but quiet enough that most people will squander it. They will wait for next quarter. They will wait for the next Fed meeting. They will wait for their advisor to become alarmed. They will wait until prices make the problem emotionally undeniable. And when that day comes, they will discover that the world charges a brutal premium for clarity. I would rather pay the smaller price now, which is the discomfort of acting before applause. So, if I were sitting across from you today, this is what I would say in one sentence. Do not build your financial future on paper, promises that require yesterday's world to keep functioning exactly as it did. Build it on scarcity, pricing power, liquidity, and productive necessity. That is how I would prepare for the next 18 months. That is how I would protect what I built. And that is how I would put myself on the right side of the next great transfer of wealth. Let me go one layer deeper, because this is where the real separation happens between someone who merely agrees with the thesis and someone who can actually execute it. The hardest part of a late cycle is not analysis. It is identity. A great many people have built their sense of prudence around looking conventional. They drive the approved car, own the approved funds, repeat the approved phrases, and interpret the comfort of belonging as evidence of safety. That works beautifully in the middle years of a cycle because the system is rewarding compliance with conditions that still favor it. Late in the cycle, that same instinct becomes a trap. A person who has tied his identity to always being reasonable will often refuse to do the one reasonable thing that no one around him is doing. He will call it overreaction. He will call it pessimism. He will call it waiting for better evidence. What he really means is that he does not want to look different before different becomes fashionable. That is why I think of this period as an examination of temperament more than intellect. The arithmetic is available to anyone willing to look at it. The debt load is visible. The interest burden is visible. The dependence on refinancing is visible. The fragility of long promises in an inflationary or liquidity-starved environment is visible. What is rare is not access to the facts. What is rare is the emotional stability to rearrange your life around them before social proof arrives. That is also why I want a written protocol, not a vague intention, not a mood, a protocol. Mine would look something like this. I would define a target range for each of the 4 categories, and I would move toward them on a calendar, not based on how I feel after watching the market for one dramatic afternoon. I would cap speculative exposure at a level that cannot alter the architecture of the whole household if I am wrong. I would lower obligations where I can. High fixed personal overhead turns even a smart portfolio into a fragile one because it shortens the time you can wait. I would hold enough liquid reserves that a 6 to 12 month period of market stress does not force me to sell anything important. I would stop reaching for yield in things I do not truly understand. I would know, in plain language, what each major position is supposed to do for me in a crisis. Preserve purchasing power, generate rising cash flow, maintain liquidity, hold value outside the credit system. If I cannot explain the job, I probably should not own it in size. And then I would review that structure every month for 6 months. Not because the world changes every week, but because drift is real. New money comes in, prices move, old habits reassert themselves. A serious portfolio is not built once. It is kept honest. The reason, what do I think the market will do next week? Am I becoming structurally stronger each month while the window is still open? That is a much better question. Forecasting exact timing flatters the ego and usually punishes the wallet. Strengthening the structure of your own position does the opposite. It humbles the ego and protects the wallet. Now, there is another point I want to make because people often misunderstand what surviving a debt cycle really means. Survival is not the same thing as hiding. I am not telling you to crawl into a bunker with canned food and coins and wait for civilization to reset. I am telling you to distinguish between wealth that is merely marked high on a statement and wealth that can continue serving you when the rules of valuation get meaner. That is a very different thing. A resilient portfolio still owns productive enterprise. It still owns assets that can appreciate. It still participates in the future. It just insists on better terms for participation. It insists that some assets be outside the paper maze. It insists that some businesses have the right to reprice. It insists that some reserves remain liquid and unemotional. It insists that some ownership be tied to the physical needs of ordinary life. In other words, it asks the future to prove itself before you hand it all your capital. That, to me, is not fear. That is self-respect. It is also worth remembering that late cycle wealth is often lost in two stages, not one. The first stage is the obvious drawdown. Prices fall. Statements shrink. Everybody notices. The second stage is quieter and often larger. It is what happens after the drawdown to people who no longer have the confidence or liquidity to act. They stop compounding. They stop buying. They become defensive in the most expensive way, which is after assets are already cheap and after their own psychology has been damaged. That second stage is where years disappear. A resilient structure prevents both stages. It reduces the damage of the initial break, and it preserves the ability to buy, add, and act while others are trapped in recovery mode. That is why short-term treasuries and cash are not just defensive holdings to me. They are future offense in storage. That is why pricing power businesses are not just stable holdings to me. They are compounding machines that can keep working while money itself is being cheapened. That is why productive, real assets are not just inflation plays to me. They are anchors tying wealth to real use. And that is why precious metals are not some ideological statement to me. They are a refusal to denominate all my security in a system clearly incentivized to weaken its own unit of account. Once you see the portfolio that way, the whole thing becomes less abstract. You stop thinking in tickers and start thinking in functions. You stop asking what is popular and start asking what survives. You stop chasing the best-looking chart and start asking which assets can cross a broken bridge. That is the identity flip I care about most. The average investor wants to be right. The prepared investor wants to be intact. The average investor wants the satisfying feeling of participation. The prepared investor wants the enduring power of optionality. The average investor wants to look smart in the final act of an aging boom. The prepared investor wants to own the next decade after the boom is repriced. Those are very different ambitions at this stage of my life, and perhaps at this stage of yours, I know which one matters more. So here is the test I would leave you with. If markets were closed for 6 months and headlines grew steadily worse, would your current structure make you calmer or more desperate? If inflation stayed higher than expected, while rates stayed uncomfortably firm, would your portfolio defend your purchasing power or slowly leak it? If a major drawdown created once-in-a-decade prices, would you have the liquidity and confidence to buy, or would you be one of the people creating those prices for someone else? If you cannot answer those questions with confidence, then the issue is not your intelligence. It is your structure, and structure can be fixed quietly, deliberately. Starting now,